Now, moving to the Basel norms. What I mean with the Basel norms, why there was a requirement of Basel norms? Sir, which Basel norms are implemented in India? There are so many questions that are being in your mind. See, first, if I talk about, guys, I told you that a banking system operates in a multi-risk environment. Banking system operate in a multi-risk environment. Now, number of times I have told you that, sir, you have said multiple times multi-risk environment, multi-risk environment. Sir, can you give little bit more specific about that? That, sir, what do you mean by this multi-risk environment? See, if I'm talking about this multi-risk environment, I know that bank, if it is operating in a multi-risk environment, so sir, what are the risks that the bank faces? I told you there are three major type of risk that the bank faces. One is known as credit risk. Second is known as market risk. Third is known as operational risk. Third is known as operational risk. So the whole point is there are three type of risk that the bank faces: credit risk, market risk, operational risk. Now, when I talk about these three type of risks, the first is credit risk. Obviously, see, bank has given a loan. Just look at it here. See, obviously, bank has given a loan. That creditor might not be giving back the loan back to the bank. Isn't a risk? Definitely there is a risk. And if there is a risk, that's why they are getting a reward. And what is that reward? Interest payment. Are you getting my point? Obviously, there is a risk. Because there is a risk, then only they are getting a reward known as interest payment. So bank operates in that credit risk environment where there is a risk of, you can say, creditors being defaulted. They are not willingly giving back the money back to the bank. They might have willfully defaulted, or somehow they are like not ready to repay their loan back to the bank. Clear? That is known as credit risk. Second, market risk. Definitely market. See, sometimes what happens that the market sometimes crashes and you don't even know, you are not expecting, but market crashes. Now tell me, when that market crashes, don't you think so the economy comes down? The overall growth rate of the economy, that slows down. And when economy slows down, tell me, how can the borrower be able to repay the loan? He wanted to give back, he wanted to repay, but it is because of the market circumstances, he's not able to generate a revenue from which he will be able to return back the loan. So that risk is known as market risk. Third, operational risk. Now, what I mean with the operational, see, sometimes what happens due to collusion between the banking officials and the borrowers, bank gives a big loan without taking any collateral, without undertaking any due diligence about the borrower, just because there is collusion. So because of the operational factors also, there's a possibility that we have given a loan from which we cannot be recovered, That is known as operational risk. Clear? So this is what I am talking about, that bank operate in a multi-risk environment and there is a possibility that bank can meet unexpected losses. Yes or no? There is a possibility that because of such risk, bank can face unexpected losses. Now, to ensure that bank does not go bankrupt, there's a possibility that bank can also go bankrupt if the money don't come back. So to ensure that bank does not go bankrupt, which in our technical term is known as bank run. In our technical language, it is known as bank run. So what I mean with the bank run? Bank run refers to a situation when bank goes bankrupt. Clear? So this is what I'm talking about. To meet that unexpected losses, to absorb that unexpected losses, to meet with their obligations, the bank should set aside more capital. The bank should set aside more capital, and that is what have been recommended under the Basel norms. So what are the Basel norms? If I talk about, Basel norms are a series of, let me tell you guys, Basel norms are a series of regulations, international banking regulations, series of international banking regulations developed by Basel Committee on Banking Supervision. Developed by Basel Committee on Banking Supervision. It is the primary, this Basel Accords, or sorry, you can say Basel Committee on Banking Supervision is the primary global standard setter for banks regulation. Basel Committee on Banking Supervision is the primary global standard setter for the bank regulation. Now, these Basel Accords, which have been established by this BCBS, they simply have a single aim. The aim is that the bank should set aside more capital. It says that the bank should set aside more capital. Banks, Basel Accord simply says that banks should set aside more capital. It simply talk about capital regulations, capital to be set aside, capital to be set aside for absorbing unexpected losses and meeting sudden obligations of the depositors. This is what about the Basel norms is. Simple concept. That how overall what it is trying to achieve. Overall Basel norms is trying to strengthen the international banking system. Overall Basel norm is trying to strengthen the international banking system. Yes or no? Overall Basel norms is trying to strengthen the international banking system. This is what about the concept of Basel Accords. Clear? These are series of regulation developed by Basel Committee on Banking Supervision, which aim to strengthen the international banking system. And how? By keeping aside certain capital, by putting in place certain capital restriction for the banks, so that they set aside certain capital which can be used to absorb unexpected losses and meeting certain obligations, certain demands, certain obligations of the depositors. Clear? So there are three Basel Accords that have come into picture as of now. If I talk about three Basel Accords, the first Basel Accord, clear? There are three Basel Accords. If I talk about three Basel Accords, the first Basel Accord came into place in 1988. Basel I was adopted in 1988. But you see, Basel I simply only focused on the credit risk. Basel I entirely focused on the credit risk, guys. It has not taken into consideration the other risk. That okay, there might be a market risk because of which the borrowers might not be able to repay the loan. So thereby, Basel II came into picture in 2004. Now you see this Basel II, guys, try to remember. This Basel II has witnessed a crisis known as Asian crisis. There was a crisis in 1999. There was an ASEAN crisis that happened during this period. So there is an economic crisis that happened during that period, and Basel II, then it considered the different type of risk. And the Basel III came into place in 2010. Basel III came into place in 2010. Again, after the global financial crisis. After the global financial crisis, Basel III came into place. India is implementing Basel III right now. So, we are implementing Basel III right now. Now, sir, do we have to read Basel 1, Basel 2? Not at all. Not at all. Let me now enter into the Basel 3 norms. Clear? See, if I talk about the Basel 3 norms, Basel 3 norms continued with three-pillar approach that was adopted. This three-pillar approach, actually it was adopted under whom? Under Basel II. Three-pillar approach that was adopted under Basel II norms. Clear? So Basel III norms, if I talk about, Basel III norms continued with those three-pillar approach. Now, sir, what was that three-pillar approach that was adopted under Basel II? The pillar number one, we have discussed this idea that obviously the first requirement would be minimum regulatory capital requirement. That how much capital banks have to set aside. That is actually the major importance of the Basel norms. So minimum regulatory capital requirement as a percentage of risk weighted assets. RWA means risk weighted assets, as a percentage of risk weighted assets. Clear? Minimum regulatory capital requirement as percentage of RWA, that is risk weighted assets. Now you see, we have understood that idea that okay, bank provides the loan, which is called an asset. Now when everyone is, try to understand, when everyone is giving the money, all of them kind of have the same weight. All of them kind of be having the same risk. Clear? Now, but try to understand, certain loans which were given to the people, they were given for a longer period of time. Don't you think the risk increases for a longer period of loan? Yes. So then, sir, don't you think for that loan, risk is higher? And when risk is higher, risk weighted at says that fine, you have to get an average, but you have to take a weighted average, and that weight is based upon the risk. I am pretty sure that you must be having a good idea of the average, weighted average kind of stuff. Clear? So again, I am just pointing it out, guys, that RWA, risk weighted assets. Now, what I mean with the risk weighted assets, see, there are assets which are given, that is loans which are given by the bank. Now, each loan carries a different risk attached to it. Just for an example, I am giving you an idea that certain assets which are long term, definitely they carries a higher risk as compared to the short term. And that is why you must have seen that the lending rate, the interest rate on that long term loan is more. Higher the risk, higher the reward. Clear? Second, if certain people have missed their due payments, what is going to happen? If certain people have missed their due payments, again here guys, I just like to point out, if they have missed their due payment, the risk increases for that asset. So RWA, guys, is the like finding out an average of all the assets, but there's a weighted average, and that weight is based upon the risk. If some asset have turned NPA, that means they're not giving any interest, no installment is coming up, and the due period has become for more than 90 days, then the risk increases more. Then that RWA would be higher. Clear? So that is the term known as risk-weighted asset. So Basel III norms clearly says that the bank has to set aside a certain percentage of capital as a certain capital as a percentage of risk-weighted asset. And this, it says, it recommended through a concept known as capital adequacy ratio. This it recommends through a concept known as capital adequacy ratio or capital to risk weighted asset ratio. Capital to risk weighted asset ratio. And what is that? It says the additional capital that needs to be set aside, additional capital to be set aside as a percentage of risk weighted assets. As a percentage of risk weighted assets. Any doubt here? Additional capital to be set aside. So this CAR is known as capital adequacy ratio. Capital adequacy ratio. That how much capital is adequate enough to absorb that unexpected losses or meeting the sudden obligation. Or CRR is also capital to risk weighted asset. Try to understand, capital to risk weighted asset ratio. That is known as CRR. Clear? Just if in case anything is asked in the examination, you should be able to answer that. Capital to risk weighted assets ratio. Clear? CRAR. Capital to risk weighted assets ratio. So Basel III norms recommended that the banks should have a minimum, should maintain a minimum 8% CAR. Basel III norms, guys, recommended a minimum of 8% CAR. Clear? Again, I'm saying Basel III norms recommended a minimum of 8% capital adequacy ratio. That means if the risk weighted asset something like suppose 100, it should be something around 8. That additional capital has to be set aside is 8, minimum 8. Clear? Multiply by 100%. If you find it out, if you calculate in terms of percentage, multiply by 100. Clear? This is what the Basel norms clearly says. Now, there is more technicality, but I will not suggest you to go into that detail, but still I am just highlighting it so that in case a concept is asked, you should be able to like think that, okay, suppose if I ask you which of the following best describes tier 1 capital, you should be able to like answer that question. I'm damn sure that there will not be that detailed question going into tier 1 capital and giving you multiple statement. No. So even here also Basel III norm says that fine, you have to set aside this capital, but this capital is divided into two types. One is tier 1 capital. Tier 1 capital and another is tier 2 capital. It is actually the tier 1 capital is the core capital that has this additional capital which you are setting aside, it should be tier 1 and tier 2 like that. Tier 1, tier 2. Clear? So if the Basel III norm is recommending 8%, if Basel III norm is recommending 8%, it should be something around 5.5% or 2.5% like that. Clear? Let me see if I have given this. Yes, so tier 1 capital, see, I have given it to you. That this capital adequacy ratio can be understood into two types of capital, tier 1 and tier 2. Any doubt here? No. Clear? Now, I hope you have understood. Suppose, now I'm just giving you more analysis now. Suppose bank has given 200 rupees as a loan, overall loan. Suddenly, 100 rupees of that loan has turned NPA. When this 100 rupees loan has turned into NPA, what about this risk weighted assets? Will that increase or decrease? Tell me. So this risk weighted assets will increase. When this risk weighted assets will increase, keeping the capital same, what will happen to that immediate CAR requirement? It will come down. Because numerator is same, if denominator increases, the value of this will come down. When the value of this come down, it can happen. Please try to remember, it can happen that the CAR, the CAR goes below the minimum. The CAR goes below the minimum, guys. That is, the minimum is what? 8%. The CAR goes below the 8%. So thereby, then what the banks have to do? Banks have to set aside more capital. They have to increase the capital that needs to be set aside, which cannot be undertaken for lending. This is how the banks will maintain the CAR. Yes or no? This is how the banks will maintain the CAR. This is how the banks will maintain the CAR. So I hope you have understood this aspect. Clear? So if the risk-weighted assets increase, that means the banks have to set aside more capital to go above the minimum CAR requirement, because this is the minimum they have to maintain. Clear? I hope you understood the pillar 1. That is the major important part, that Basel III recommended a minimum regulatory capital based on risk-weighted assets. So there are 3 types now we have discussed. Based, like the money when we have to set aside, either you set aside as percentage of NDTL. We have discussed that idea, known as what? The fractional reserve banking system, or the reserves as a percentage of NDTL. Second, when it comes to lending, the parameter that is used, ANBC, adjusted net bank credit. And when it comes to the capital adequacy ratio, the new parameter based on which the capital is set aside, known as RWA, risk weighted assets. Clear? And Basel III recommended how much? Minimum 8%. But now, while Basel III norms recommended 8%, RBI in our country, RBI recommended in our country minimum 9%. Yes or no? RBI recommended minimum 9% CAR. Are you getting my point? RBI recommended minimum 9% CAR. Minimum 9% CAR. They have recommended. And let me tell you guys, RBI have recommended minimum CAR requirement for different categories of bank. Minimum requirement for different categories of bank. Like for public sector banks. For public sector banks, RBI recommended, see RBI, let me tell you, recommended that public sector banks should have a minimum 12%, although it has kept mandatory for the public sector banks that it should be minimum to 9%. But simply it have generally recommended that public sector banks might face huge losses. So thereby it is recommended for the public sector banks to have a higher CAR of above 12%. But at least minimum to is 9%. What about the private sector bank, including foreign banks? 9%, guys. Guys, please, those who have this old edition of the Pulse handwritten book, please correct there. That is private sector banks, including foreign banks. It is not minimum 12%, guys. It is minimum 9%. Clear? Minimum 9%. Then moving to, you see, a small finance bank and payment banks, minimum 15%. They are the new age banks. And new age banks, they are putting a higher capital requirement. Urban cooperative, 12%. Regional rural banks, 9%. Sir, what about NBFCs? Sir, there are non-banking finance companies. Are there any CAR requirement for NBFCs? Yes. Yes. So now if I ask you that, sir, if a bank is having higher capital adequacy requirement, is that bank likely to fail? You will say no. Why you will say no? Because that bank have enough cushion. That bank have enough cushion to absorb the losses. Clear? So this is what about the pillar 1. Then, sir, what is pillar 2? See, if I talk about the pillar 2 now, pillar 2 is supervisory process. Supervisory review process by the central bank. So it is said that the central bank should go for better tools and techniques for reviewing the performance of the banks. So if you look at that, the banks were needed to develop and use better risk management techniques in monitoring and managing all the 3 types of risk that a bank faces. So there has to be higher review, a better review, advancements of tools and techniques. And lastly, pillar 3 is market discipline. This is nothing but simply, I would say, more of subjective kind of a thing. Market discipline. So market discipline means increased disclosure requirements, ensuring transparency. When say there is increased disclosure requirement, when there is transparency, obviously they are likely to give true data. They're likely to accept that yes, they have set aside this much of money in the form of care, like that. Clear? So this is about the Basel III norms.